Well, the Chinese economy, look, there's no secret on this. I've said it on CNBC many times. There are far more intelligent people than me who've been saying it on many other platforms too. It's an investment-driven economy, an over-investment-driven economy. That investment is increasingly making negative returns. Every single sector of the Chinese economy is drowning in debt. But the transition away from that towards consumption can't be done without everything getting far worse before it gets better, and without running very much in the opposite direction to the very sensible policies that they're talking about in some regards under the umbrella of common prosperity. So it's extremely difficult to take an over-investment-based economy and suddenly say, now we're going to be all about consumption. And that's why we're getting measures like longer restaurant opening hours and food festivals, as if somehow this is going to incentivize consumption, when actually, when you dig down into the details of what they're doing, they're still talking about boosting supply of consumer goods and presuming that will make people buy more of them. They won't if they're all in debt. And if too much of the economy continues to throw good money after bad on infrastructure that isn't needed and real estate projects which are absolutely flat on their back and losing water, or underwater, excuse me. So the structural shift that needs to happen needs to be remarkable. And what we've seen so far isn't it. I think markets are way ahead of themselves yet again in pricing for the fact that you're going to get a Western COVID-style stimulus package coming out, because even that would only be putting a plaster over a wound. And we're nowhere near seeing that yet.
Say I agree with you, Michael, in terms of all of these problems that you're elucidating on. And the need to address them is obviously as significant as you're suggesting. But do the authorities at this point in time, and perhaps even, if we're talking about the next couple of years, do they, in so much as they might want to, do they have the political capital to do what needs to be done that you're talking about? Because BandAids, they might not be the best, but they work, and they're not anything that's going to, imperil the economy, imperil, some of the financial outcomes of people that are already a little bit aggrieved. We saw what happened last year in terms of the property market. So should we be expecting anything significant then, or just Band-Aid, Band-Aid, Band-Aid? Thanks for coming.
Well, at the moment, it appears that it's the latter. And to underline again, even if we were to get what markets are drooling like Pavlovian dogs about all the time, wrongly, which is another big fiscal stimulus package, similar to that seen in 2008, which, by the way, laid the foundations for many of the problems that China is now trying to deal with belatedly, as is also true in the West, by the way. Even if we get that, what will that mean? Okay, stocks might take off for a while. You might have 12, 18 months of fun, and then you'll have even more debt and even more infrastructure you don't need. And, more of an overhang dragging you down even more deeply afterwards. They know that. They understand that. But trying to turn around a supertanker, is a very, very difficult thing to do. There are obviously vested interests, and there are Western markets constantly foaming at the mouth and saying, when do I get my stimmy? Well, you don't, I don't think.
Let's look at the glass half full for a second, though, Michael. I mean, the markets aren't drooling. Markets aren't drooling because they're not going anywhere. Sorry?
Why do we have to keep looking at it half full? I've always wondered why that always happens.
We're not keeping looking at it half full. I just want to push back on some of those points. I mean, the markets are not drooling because they're not going anywhere. The valuations are relatively extremely low compared to everywhere else. And people have been talking about the structural problems of China's market transition for many years, you among them. It's not an easy thing to do. And they're still registering 4, 5, 6% economic growth, so they're not doing too badly in trying to pick their way through what is an extraordinarily complex maneuver.
Well, I don't really buy any of that. I mean, the markets are flat on their back. You've just had a little bump of 4 or 5%. And what I am saying, as someone who doesn't give investment advice and isn't managing a portfolio, and I'll make that very, very clear, is that does look to be getting well ahead of itself, as it has done in previous iterations of this same meme. Growth this year, it's probably going to have a 5 handle. It may do. But that's coming off of a post-COVID low. There are a great number of very, very credible voices far closer to the ground than myself saying that the structural rate of growth in China is heading to 2 to 3. And I think there's broad recognition that would actually be healthy for the economy in many respects. I actually do see the glass being half full, ironically, in some of that, in that what's the point in having 5% growth and frothy markets if it doesn't reflect common prosperity and a stable underlying macroeconomy? It's probably far healthier to say the markets are going to remain flat for a very long time and growth will be far lower for a very long time if that's what's needed for a transition. But the memes I'm seeing around at the moment, over the last couple of days in particular, are again, recovery, bounce, stimulus, et cetera, et cetera. That's not really what's happening here. It's a very long, very slow grind, which will be very difficult to achieve, to try and shift towards a different economic model from the one that we've been used to for a very long period of time. And for people who are day trading stocks, I'm sorry, it's going to be very boring for a very long time.